Good evening, everybody. Welcome to Zoom at 8. My name is Julie Ann Peterson, and I'm with Old Capital Lending. And tonight, we welcome you all to Zoom at 8. We are here every Tuesday night. Every Tuesday night, you can find networking and typically a really good speaker. And tonight is no different than what we usually have, except for last week, we had networking. And thank you so much, Bruce Abramson, for helping me out. You're an awesome co-pilot. So a little bit about Old Capital. We are a premier provider of debt, whether it's bank, bridge, agency, CMBS. So we can help you, but we are a little bit different. I run my business a little different because I try and put people together. You know, over the last 2 years that I've been running Zoom at 8, we have now closed 7 deals within our community. So who's going to be number 8? I'm excited to figure out who from Zoom at 8 is great and going to get number 8. So at any rate, if you're working on a deal where you need a sponsor or you need an insurance company or you need a property manager, I'm happy to help you. And a lot of my partners are going to be here tonight. I may be missing somebody. Maybe there's 2 JTs in the house. I don't know if JT's here yet. But at any rate, oh yes, there are 2 JTs. Look at that. That's fantastic. At any rate, if I can help on your debt quote, we're going to need your T12 and rent roll and your analyzing tool. Tonight, we have an amazing speaker. He's been here before. He's kind of like peanut butter. You just want to spread him around. So I asked him to come back. Chris Nebenzahl is the editorial director at Yardy Matrix. And if you're not familiar with Yardy Matrix, it is an amazing tool. We use it here at Old Capital. It gives us lots and lots of data. And as you know, we need to be using data to make assumptions and to make decisions. So he is responsible for overseeing market research and data analytics, as well as editorial composition for Yardy Matrix, commercial property executive, and multi-housing news. Chris facilitates the expansion of the Yardy Matrix reporting suite and provides in-depth analytical tools for clients across the commercial real estate industry. His focus includes data analytics and reporting for the multifamily, office, storage, and industrial asset classes. Before joining Yardy, Chris served as a portfolio manager at the Bank of New York Mellon, managing fixed income portfolios for municipal and public sector clients across the United States. He holds a bachelor's degree in economics and a master's degree in finance, both from the University of Denver. So Chris is here from Denver. It's not snowing yet, but Chris just had a baby 6 months ago. His life has changed forever. And, you know, we are just so thrilled to have you, Chris, both as a business partner, but also as a friend. So I want to thank you so much for taking time away from your family. I know that as we have kids, that time allowance that we have is cut short. So I do appreciate you spending time with us. Chris is going to share some information with us. So I highly recommend you go to the top right little squares. If you press it, says view, bring down the speaker view. And let's give our attention to Chris Nebenzahl. Chris, how are you tonight?
I am great, Julie. It is great to be here, and thanks for the opportunity to come back and talk with this group again. Julie, I appreciate you reading that wonderful bio of me, but what do I really do? What is Yardy Matrix? It is a real estate data platform. So any of the data metrics that you would need for your underwriting, for your asset management, for your property management, we provide that. Things like sale comps, things like rent comps, occupancy levels, expense comps, ownership and property management information. All of that is housed within our database. And I have the fun job of getting to pull all the data together and tell stories. So not only do I tell stories using the real estate data, but I tell stories bringing in economic data, job growth information, GDP information, information on localized employment, demographic information, migration. If anyone was here last year when I was on, We talked a lot about migration, and migration is one of my favorite stories to talk about because it's really what is driving multifamily in the industry today. So I will go through a little bit of the data as it says here. I'm going to be digging into the data, what's happening in multifamily. If anyone has any questions, please feel free to cut me off. I'm overcoming a bit of a cold that I think I picked up from my young daughter's daycare. So hopefully I don't sound too much like a frog, and hopefully I don't have too many coughing fits, but that might give me an opportunity to grab some water and slow down if anyone has any questions. So feel free to just jump in and blurt them out. But with that said, can everyone see my screen? Thumbs up, thumbs down if the screen is looking good. Okay,
Yep, looks
then
good.
let's get going. So where are we from a housing demand, rent growth, and occupancy perspective? Well, 2021 has been one of the best years in history for housing demand. This, I'm sure, will come as music to the ears of many people on this call, not all of the people on this call, because what are we doing? We're here to put deals together. One thing I forgot to mention about myself, not only am I the editorial director for Yardy Matrix, but I'm also an active LP and GP on a number of deals. So I love talking about deals in my day job. I love looking for deals, partnering on deals in my side hustle. So I love talking to people like you, both on the 9 to 5 hat and on the side hustle hat. So I've got a couple deals that I'm working on that I'd be happy to talk about as well. But getting back to kind of what I'm here for tonight, talking about housing demand. And after 2020, we certainly know what we went through as a population and a society with COVID, but it was also a bit of an up and down year in the real estate market. Some markets got hit much harder than others. Those markets were specifically the primary markets, the gateway markets: New York, LA, Chicago, San Francisco, Boston to an extent. While other markets really kind of weathered the storm quite well. The Southeast, the Texas markets did fairly well. But what we saw really at the beginning of this year through now is that almost every market is going gangbusters. Some markets, again, are performing better than others, and we're going to talk about those markets in just a little bit. But overall, the industry is doing very, very well. Rents are up well above their long-term averages. Some markets are at double-digit rent growth, which really we don't see very often, and it might not be sustainable. But what I'm here to say is make hay while the sun is shining. We've got a great opportunity right now. Rents are going up. There's incredible demand for housing, especially in the Southeast, especially in the Southwest, especially in tertiary markets. This whole idea of where people are going to work, where people are going to live, is really at an inflection point. And my personal belief is that we're heading towards a more digital, a more virtual, a more remote working society, which should be to the benefit of a number of secondary and tertiary markets. So we'll talk a lot about those today. What's driving this demand for rent growth? Well, certainly you've heard about the high price of for sale homes. Practically in every market, the for sale home inventory is very low. The prices are shooting through the roof. It's making headlines at the Wall Street Journal, CNN, everywhere else about how expensive it is to buy a home. Us millennials can't afford to buy a home. Baby boomers are downsizing and selling their homes at crazy levels. So you know the story about what's going on in the for sale side, but also new household formation. Last year, we had negative household formation for the first time since the financial crisis. That is to be expected with the pandemic, with everything else that we were going on. Households contracted. People were moving in with one another to save money. But we also got unprecedented stimulus, government aid, additional unemployment benefits, savings rates went up. So all of a sudden, people have a little bit more money at every level of the wage and income scale. So they're able to afford a little bit higher rents. And as a result, property managers, owners are able to push rents as well. And then I'll touch a little bit about occupancies. Occupancies dipped last year, just like rents did, but they've really come back again with that household formation, with people moving around, people renting their own space, people looking for bigger units, perhaps with a home office, perhaps with a home gym, a number of different things since we've been confined to our living areas for the better part of a year and a half. So we're really going through a bit of a paradigm shift in multifamily right now. And that's a lot about what I'm going to talk about today. What markets are performing well, what markets perhaps are doing okay, but not quite as well as the top performers. And like I said, feel free to jump in with any questions as we're going forward here. So this chart just kind of blows my mind. This is the national average rent as we've tracked it. We've been tracking rents for more than 10 years now. And you see rents most of the time just kind of slowly and gradually move forward. This goes back to the beginning of January 2019. You see a strong renter season from, I'd say, late February, March into April, May, June, July, and then things kind of flatten out over the summer and tend to stay flat for the winter. Now fast forward to 2020, right in here, we see this little dip. That's the COVID dip. If we think back to where we were March, April, May of last year, none of us knew what was going to happen with the world, with the virus, with rents, with multifamily. And a lot of owners and operators cut their rents, tried to buy occupancy, tried to get their units full. And that's what you see, this little dip here. Then things kind of flattened out, a little bit of slow growth, and then look what happened. January, February of this year, rents just started taking off. And that's where we are today. And rents are up about 8% nationally, an unheard of number for the national average. To put that in historical context, the national average usually hovers between 2, 3, 3.5%. In the really frothy years of 2015, 2016, that number was around 4.5 to 5%. And we're sitting at 8.3% as of July. Just astronomical numbers. As I said, I don't expect this to continue. I don't think it really can sustain. But while we're in this period of rent inflation, as an owner, as an operator, as an underwriter, take advantage of this and use this little bump. I expect it to last through the year. It might last into 2022 in some hot markets. Use this little bump to really reset your thinking, reset your price levels for where rents are at. So let's again go back to where we were last year. This is a slide I presented to this group the last time I was on. And look where we were in July of 2020. Some strong markets, tertiary markets have been really leading the way for quite a while. Huntsville, Alabama, Portland, Maine. Michael, I know you said you're in Portland, so shout out to Portland, Maine here. The Central Valley of California, Fort Wayne, Indiana, Spokane, Dayton. Really a geographic dispersion, no real industrial or economic link between any of these markets. Some are kind of burgeoning tech markets, some are more rural, just kind of steady markets, and pretty good rent growth, 5% rent growth. I think anyone would be happy on a normal basis with 4 or 5% rent growth. But this was the top 20 performing markets a year ago today. Now let's look at where things are today. West Palm Beach, Florida, more than 20% year-over-year rent growth. Boise, Idaho, 20% year-over-year rent growth. Phoenix, a big market. A lot of these are tertiary markets, but Phoenix, suburban Atlanta, these are major metros seeing 20, 16, 18, 20% year-over-year rent growth. And this is not just one little sub-market. This is not one asset class. This is the whole market. And so you see here numbers that are really just staggering. And the trend is really starting to emerge when you look at these markets. It's Southeast, it's Southwest, it's a little bit of the Mountain West, a little bit of the Northwest when you look at Boise, Spokane, Colorado Springs, Reno, but it's really tertiary markets. Secondary markets like Phoenix and Atlanta are popping up, Jacksonville, Las Vegas popping up as well. But a lot of these markets are tertiary markets. And I think the reason that is because the cost of living is there. So people want to move where it's a little bit cheaper. Perhaps the quality of life is there. You think of West Palm Beach, Florida, great weather, the beach. Boise, you got the mountains, you got kind of the wide open space. It's a burgeoning tech scene. A lot of people moving from the Bay Area to Boise, but it's a little mini Denver, what Denver was 10 or 15 years ago. Phoenix, great weather, great quality of life, really fast growing economy, tons of jobs being added in the Phoenix area. Same thing with Atlanta. So a lot of these are lifestyle markets that people are saying, you know what, if I can work from anywhere, maybe I'm going to work from my living room or my home office for the rest of my career. I could do that from anywhere. If my company is willing to move to a Phoenix, to an Atlanta, to Las Vegas, to Colorado Springs, I might take them up on that offer. I don't need to stay in the Bay Area. I don't need to stay in San Diego. I don't need to stay in Boston. Yeah, I'll give it a shot in some of these markets. And you're really seeing the growth as a result. Sacramento, way over here on the right. Sacramento has been a really interesting market for some time. It's been one of the fastest growing markets probably for the past 5 years, with that exodus out of the Bay Area that started really before COVID. But it's still significantly more affordable than the Bay Area, and you continue to see that migration. And there's that word I referenced at the beginning, the migration. If we were to look at a map of where people are going, not just where rent growth is, but where people are moving, all of these markets would be in the top ranking for where people are relocating to. So those were the kind of the best performing markets, 12, 15, 20% rent growth. We're not going to see that everywhere. So if you tell me, hey, I'm just a Midwest person, or I'm just a Northwest investor. So here are the kind of top 5 markets in each of the 6 regions that I kind of broke the country out into: the Southeast, the Southwest, California, Northeast, Midwest, and Northwest. So you see here, pretty strong rent growth across the board. Even in California, where we haven't seen a ton of growth, especially in the big markets, Inland Empire has been on fire. Sacramento has been really, really hot. Central Valley, Central Coast doing really, really well, especially by historical norms, and especially given perhaps some of the political climate and the regulatory environment that exists in California. So if your market isn't on this list, I'm not saying it's a bad place to invest. I'm not saying it's a bad place to look, but you might want to focus on some of these markets. If you're, say a Midwest investor, some of these smaller markets like Fort Wayne, Grand Rapids is a wonderful market. I love the Grand Rapids market. Suburban Chicago is actually doing quite well. Urban Chicago, not as much, but the suburbs in the Chicagoland area have been doing very, very well. So there are investment opportunities, especially in these tertiary markets, secondary markets, where we're seeing outsized rent growth. So let's talk a little bit about occupancy. Obviously, that's kind of the other half of the performance equation. You can't just have super high rent growth if you're jacking up the rents and people are moving out, right? So some of these markets where you're seeing really, really high occupancy numbers: Allentown, Scranton, Wilkes-Barre, kind of the smaller markets in Pennsylvania, outside of Philly, outside of the New York City, the tri-state area, really, really strong occupancies. And I think a lot of that is that out-migration from New York, from the Philly area and the DC area, where you had such strong out-migration out of the urban core last year. We haven't really seen those people return to the city. I know New York was opening up a little bit. DC was opening up a little bit, Chicago opening up a little bit, but this whole thing with the Delta variant, I think, is going to give a lot of people pause to say, do I really want to rush back to that super expensive apartment, that tiny apartment, that cramped lifestyle, if I can't necessarily enjoy all the amenities, the cultural amenities that city has to offer? So again, when we think about what's going on with COVID, when we think what's going on societally, I think these tertiary markets are going to continue to outperform for some time. We look at places like the Central Valley, Spokane, Boise, and the Empire. Again, not the first markets that a Western or West Coast investor would think about, but dang, these markets are incredibly strong from an occupancy perspective as well as a rent growth perspective. Looking here at the markets that have had the strongest change year over year in occupancy, Anchorage pops up. Interesting market. I don't hear a lot about Anchorage. I'd be curious if anyone on the call is investing in the Anchorage market, but strong occupancy growth. Asheville, North Carolina, Southwest Florida coast, West Palm Beach. You don't see Miami on here. You see Miami over on the side, but it's not quite as strong as a West Palm Beach. Southwest Florida coast as well. You don't see Tampa necessarily, but the Southwest Florida coast, that includes Fort Myers, Bradenton, doing a little bit better than the I'd say the key market, the Tampa market, as the bigger market in that area. And so again, this just adds support to that tertiary market thesis, or that secondary market. Suburban Atlanta. Urban Atlanta is doing okay. Suburban Atlanta is doing a little bit better. Again, more in support of a little bit more space. The suburban areas, the less dense areas, are really the markets that have outperformed in the past year to year and a half. So that kind of wraps up the data and my quick spiel. I was telling Julie at the beginning of the program, I've got my kind of master data sheet with all of the markets we track pulled up right behind me. So if there's any market that you want to dig deeper into, if there are a couple markets that people have questions on, if you have any questions on any of the data that I presented, I'm happy to go back to the slides. But I know we've got about 15 minutes and a little bit longer if we run over, but happy to take questions. Happy to share kind of any of the deals that I'm working on as well. And yeah, just really leave it open-ended for questions from anyone on the call.
All right, let's see. Let's stop sharing. Let's see. There we go. All right, perfect. I know I have a question. So California, we see a lot of California cities on there. I'm in California. I sold all of my property in California. What is the thought on that with tenant rights and landlord no rights? And you know, that's disastrous to me. So I'm curious to hear your thoughts on that.
Yeah, absolutely. I'm in no way, shape, or form a political expert or a local political expert. But Julie, you mentioned some topics of concern, I would say, that any investor in California needs to have top of mind. What's going to go on with rent control? What's going to go on with eviction moratoriums? I think if you're dedicated to California, you want to be looking outside of the key markets. LA is going to be a tough market to operate in and to drive rents. San Francisco is going to be a tough market to operate in and drive rents. Julie, you're the San Diego expert. I won't try to act as that expert, and perhaps you could share your thoughts on San Diego, but you didn't see San Diego on the top of any of those lists. You saw markets like the Inland Empire, Riverside. You saw markets like the Central Coast, the Central Valley. You saw markets like Sacramento. Those markets are still perhaps at risk of the same policy, but perhaps those markets aren't at quite the same level of risk that the biggest markets in California are. Again, I'm not here to tell you to invest or divest from California, but I think in any market, Oregon as well, Portland passed rent control, in the state of Oregon passed rent control a couple of years ago. New York is always talking about expanding their rent control. It's something that we as investors need to be top of mind of. And not to say that you can't make numbers work. You can't make strong rent gains achievable in these markets, but it's an additional pressure. It's an additional externality that has to be considered in any investment and underwriting decision. No question about it.
Thank you. John has a question. You're up.
Yes, I have a question. What your data is it based on? Is it based on census data, or is it based on the culmination of various data sources, or is it your own data internally?
Yeah, so all the data that I showed today is our own. So we call all of our properties. We track a database of about 100,000 multifamily properties, 50 units and above, and we call all those 3 times a year to get their rents, to get their occupancies, and every month we call about 25,000 properties to do some intermediate surveying and sampling. So all of the rent data is our own internal data. We're also able to, using Yardy's property management software, double check some of the data that we have to ensure that our numbers aren't kind of wildly disparate from what the actual rent rolls are. So yeah, all of this is internally sourced and internally curated.
All right, I have a question, and I do want to give you a little bit of time at the end to make sure that we understand what Yardy Matrix is, because I think it's a great tool, and I think that there are ways to use it as an investor, not just as from a broker standpoint, whether it's a mortgage broker or it's a property real estate broker. And I think I'd like to make sure that everybody knows, because it's a great tool. So we'll leave a little bit of time for that. But Bruce Strong, who lives in the Denver area, asks, what data do you have for Grand Junction, Colorado area?
Unfortunately, we do not track Grand Junction. It's a bit too small for our market universe. As a Denver local, I would love if we tracked more of the small mountain regions, because I think Grand Junction has a lot of investment opportunity. You know, if Boise is the Denver of 10 years ago, I could really see Grand Junction as a mini Boise. You're going to start to see these lifestyle markets, and if you know Grand Junction well, it's a great lifestyle market out there on the Western Slope. You're going to start to see these really gain interest. Another one I'd throw out there is St. George, Utah. I know you've got some familiarity with St. George. Really kind of interesting pockets of the Mountain West that I think are going to get very, very sought after from both a migration perspective as well as an investment perspective, because there just isn't that much inventory out there. So any deals that you can scoop up, I think will be doing well. But unfortunately, we don't have hard data on that market yet.
Okay.
Thanks.
Yep. Chris Pauling is curious what you see in the data that is driving the rent growth and high occupancy in the Tri-Cities of Washington. That is we've seen a huge amount of growth there.
Yeah.
Yeah.
And that's another really interesting market. I'd say the secondary and tertiary markets of Washington have been doing very, very well. Spokane, Tacoma, Tri-Cities. Seattle, I think, has seen a little bit of outmigration. Portland, I think, has seen a little bit of outmigration. And the Tri-Cities, I think, stand to benefit from both of those. They're a little bit more rural, as you know. But I think the affordability, the cost of living in those markets, the lifestyle that those markets offer in terms of kind of outdoor amenities is really, I think, what's driving that market, and the ability for people to work from home. So I expect to see that to continue, not forever. Perhaps if the outmigration reverses back to Seattle, back to Portland, back to the Bay Area, then some of these tertiary markets, Tri-Cities included, might suffer a little bit or might slow down from the astronomical numbers that they're seeing a little bit. But I think, as I said earlier, the longer we are in this virtual, remote, work from home, whatever you want to call it, lifestyle, the longer people are going to say, and the more people are going to say, you know what, I like living here. I like living in a smaller market. I like living in a more affordable city, in a more affordable town. I think I'm going to stay. And I think a lot of companies are going to be faced with the fact that if they want to keep their talent, if they want to keep the best employees, they're going to have to let them stay remote.
Do you see any data that's showing that this migration out of these bigger cities is going to be returning, and how long that you think that that's going to take?
Yeah.
Do you guys pull any of that data?
We have seen a little bit of data, and the best proxy we have are the rents in the urban core in New York and San Francisco and Chicago. They bounced a little bit in the spring, but they've really leveled off and started to fall again in the past couple months. So I think the initial surge was, okay, I did it. I left for a year, but you can't pull me away from Broadway. You can't pull me away from downtown San Francisco. You can't pull me away from the Loop in Chicago. I'm going to go back. And those people went back. But what we saw is that the amount of people who left, the outmigration from last year, was significantly more than the return or the re-in-migration this year. And so for those markets, and look, I'm not saying that New York is going to cease to exist, that San Francisco won't be the major gateway market that it is. I just don't think it will return quickly. And I don't think you'll see the best investment returns in those markets. And I think it could take 2, 3, 4, maybe 5 years for those markets to regain the population, regain the job growth. I was looking at Moody's analytics. They put out their job growth estimates for this year and last year. And most of these secondary markets that we've talked about, Phoenix, Denver, Atlanta, Austin is a market that you couldn't find a better job growth market right now than Austin. Dallas is another one that Moody's Analytics is forecasting in 2021 that they'll add about 200%. So twice the jobs that they lost last year will be added this year. and about 3 times the number of jobs that were lost last year will be added next year in most of these markets, these secondary markets. What Moody's Analytics is predicting in the major gateway markets is that it'll take a year to 2 years to 2.5 years for those big markets, San Francisco, New York, to even return to their pre-COVID job numbers. So you see some secondary markets that are going to eclipse their pre-COVID job numbers this year. You see primary markets that are probably going to take into the end of 2022, into 2023, just to get back to their pre-COVID jobs numbers.
Wow. Bruce, I think you have a question. I saw your hand up.
I do. And I just wanted to kind of concur with what you're saying, Chris, because, I'm in the Lakewood Ranch, Florida area, in the Bradenton area. And for one, people are coming from everywhere. I mean, they're just coming from anywhere. The first 6 months of the year, Lakewood Ranch sold 2,200 new home sales. And the builders literally had to shut down the sales. And then I can count off the top of my head 7 new complexes, units that have come out, or doors, with probably a minimum 300 doors each, that have come out of the ground in the last year. And one just came out of the ground 6 months ago, 300 doors, and it's completely, it's full. And the rents that they were getting were anywhere from $1,800 to $2,600 a month on those places. And we were looking for places, we couldn't find anything to rent. So, I mean, it's crazy.
Yeah. And I think you're seeing that in a lot of these hot migration markets. Southwest Florida, for actually all of Florida, I should say.
Right.
Tucson, Phoenix, Arizona, the Texas markets, the I-35 corridor, from Dallas all the way down to San Antonio. You're seeing the in-migration from all over the place, from the Northeast, from California, from the Midwest. And like you said, they're building homes and they can't build them fast enough.
Yeah, and record low vacancy rates too. Record low vacancy rates. Just, it's great opportunity for some.
Yeah. Kevin O'Brien, Chris has a question. What trends are you seeing in student housing recently and projected? What do you think about that asset class?
Yeah, student housing, I think, has a lot of opportunity. It's going to depend on the school. When we talk about markets, oftentimes, you've got a whole MSA, right? So you can kind of spread out across the entire Phoenix MSA or across the Denver MSA, and that could encompass, a radius of 30 miles. Student housing obviously is much more localized. So you look at a school like UT Austin, doesn't have a ton of off-campus dedicated inventory, but a ton of new supply is coming online. So I think you'll see a little bit of a rocky road in some of these markets where there's opportunity to develop. There are going to be a lot of students there looking for off-campus housing opportunities, but until they absorb all the supply that's coming on, you'll probably have a bit of a rocky road. The other big kind of story, or the big question in student housing, is what's going to go on with the universities. A lot of people studied from home, studied remotely last year. A lot of universities had said, this year's a new year. We're going to bring everyone back to campus. We need that housing revenue. We need that vitality on campus. And then schools are starting to walk that back. Some schools are requiring vaccines. Some schools are going to require vaccines if it gets FDA approval. Some schools are not going to require vaccines. Some schools are going to have COVID outbreaks, because we know college kids tend to not be the most socially distant individuals. No offense to any college kid, but that's not their main priority. So I think when we look at the short term, the immediate future of student housing, you got to focus on what that school is doing from an operational perspective and how that's going to impact your bottom line. I know a lot of people, I was talking to some operators at Purdue University a couple months ago, and they had a really tough year last year because there were a number of outbreaks. They had to completely kind of overhaul their operations. And it was a tough go of it. But long term, if you're in the right university, I think there's good opportunity for student housing.
I do have a question. So we've got BTR, build to rent, and we also have motel conversion, hotel motel conversions. What are your thoughts on those? What are you seeing? Do you guys get involved with that?
Absolutely love the build to rent space.
Yeah.
Especially in some of these secondary markets. Phoenix is going gangbusters on build to rent. Denver, Charlotte, Raleigh, Atlanta, Nashville, tons and tons of build to rent, single family rentals. And there's a ton of demand for that right now. Bruce, to your point, it kind of flows in with the single family home developments, the
Yeah.
build to rent. People are looking for bigger spaces. If you had a one bedroom apartment, you're probably now looking for a 2 bedroom apartment if you're working from home, or if you just want some more space since you've been confined to your apartment. If you have a 2 bedroom, you're probably looking for a townhome, a build to rent space, your own entrance, maybe a little backyard, your own garage. And we've seen that industry just take off.
Yeah.
If the average rent for multifamily is 8.3% nationwide, I think our numbers last month were 11.2% on the single family rental side. I can look that up for anyone interested, but again, nationwide, 11.2% year over year growth in BTR, single family rentals, the SFR space. And again, even hotter in certain markets. Phoenix comes to mind as, 20+% year over year growth in that area.
That is hot.
Can I also just interject with that too? Again, in that Lakewood Ranch area, they had units that were like 700 square foot solo places and 1,000 square foot. Again, those are all full, but now they're starting to build 3 and 4 bedroom homes for rent, like 200 of them in that area.
That's
Yep.
the build to rent. So that's amazing stuff.
Yeah.
I highly recommend that.
I would say too, on top of just the build to rent, the bigger units are in incredible
Yeah.
demand right now. I'm working with a group that's looking to acquire and then also develop a phase 2 in Austin. And we're looking at what that site is going to look like. And I said, the more 3 beds you can add, the more 2 beds you can add. The demand for studios and 1 beds is not really there right now. Will it come back, especially in the urban core? Perhaps. But the demand right now is really the bigger units. 2 beds in a den, 3 beds, 3 beds living room. Those are the units that are renting the quickest. We're seeing the fastest rent growth. And again, to Bruce and to Julie, both of your points, it kind of bridges the gap between traditional multifamily, single family build to rent, and single family for sale inventory.
Love it. Seth.
I was gonna say, I'm sorry, and that's needed too, because like the prices in the last 3 months in those areas have gone up like 150% for like the resale homes. So the build to rent, those rentals are needed. Back to you, Julie.
Yep. I do have a question from our buddy Seth, who just moved to New Orleans. I'm hoping he knows what he got involved with, but now he's looking for some insights that you might show interesting about New Orleans.
Yes, New Orleans is an interesting market. Obviously, there's a lot of what I would say as environmental risk with New Orleans. I would put Houston in that same category. I would put a lot of the coastal Florida markets in that category as well. Good markets, lifestyle markets, but additional risk, similar to what we were talking about in California with kind of political or regulatory risks. Things like insurance premiums and environmental risks that emerge just by the nature of being in those markets. Seth, I'm sure you know, most of New Orleans is below sea level. And without taking a political stand here, I don't see the environmental concerns and the environmental issues that we've had growing in the past 20 to 30 years mitigating anytime soon. I probably see them getting worse. And that's going to have a huge impact in New Orleans. In Houston, we saw that with Hurricane Harvey. Even in Boston, I remember seeing video clips of subway lines and of basements flooding just because they had a high tide with a full moon in the middle of winter. And that's not normal. I'm originally from the Boston area. That is not a normal instance. So all up and down the Eastern Seaboard, I think that's going to be an issue. All around the Gulf Coast, I think that's going to be an issue. Not saying those aren't good markets to invest in, not saying you can't find good deals, but an additional point of emphasis, an additional point of concern that I think we all have to be aware of.
Yeah, good points. I got one more. I know I've got some other things, other people asking questions, but I want to get you to talk about Yardy Matrix, and then we got to go to networking. So last question is senior living. What are you seeing? Is there a shift? You know, are we going to have enough? What are the expectations, and in what areas are we looking at on that?
Yeah, senior living is an interesting asset class. I wouldn't say I'm super high on senior living as opposed to whether it's build to rent or traditional multifamily. I think what we're seeing is that the baby boomers who are aging into the senior living demographic are more likely to downsize into traditional multifamily, into single family build to rent. They don't want to shovel snow. They don't want to mow lawns. They don't want to take care of their property. They're big 4-bedroom, big yard, single family homes, but they don't necessarily want the assisted care that traditional senior living brings with it. And so I think you're going to see a little bit of perhaps a hybrid model, age restricted multifamily where it's even more independent than independent living. I think could do okay, but I don't know that the traditional senior housing, senior living market will be in a ton of demand based on just kind of the general demographic interest of the baby boom generation. Now, you will have some demand. The villages outside of Orlando, across Florida, across Arizona, hill country in Texas, I think you could develop or invest and have a decent property. But this sector as a whole, I don't think will perform quite as well as traditional multifamily or single family built to rent.
Yeah. Okay. That sounds amazing. And you hit on so many great points. And as I always say, I need you to come back another time because you've got so much information and we're all like sponges over here. So I'm hoping we can get you back over the next couple months or quarters to get you back. But I do want you to take a little bit of time to talk about Yardy Matrix because the platform, as I mentioned earlier, we use it. We find it extremely valuable. A lot of times people will call me and say, well, what's going on with the rents? What is the competitors doing? And for us, it works out great. It is an expensive platform, but for the dollar for dollar and the use, if this is what you do full time, you need to know about Yardy. So if you could talk a little bit about that, Chris, I think that'd be helpful.
Absolutely, yeah. And like I said at the top of the program, Yardy Matrix is kind of the full service data suite for any of your investment, underwriting, property management, asset management needs. And I talked a lot at the market level. So we offer data aggregated up to the market level, which is great for a market selection. So you're a Florida person or you're an Arizona person, but you want to go into a new market. Well, look at our data and find out what markets kind of jive with your investment strategy, and you can use that to explore new markets. But you can also drill down to the submarket level, and you can drill down all the way to the property and the unit mix level with our data to say, to Julie's point, what's happening in my deal? What are the rents in my deal? What are the rents for the comp set for my deal? What is the sale, the past sales information for this specific deal or this submarket or this neighborhood? So really, you can get very, very granular when you're looking at your deal, when you're underwriting your deal, when you're forecasting for your pro formas. You're going to need to use a tool like this because you're going to need to pitch to your investors. This is why I think it's a good deal. I don't know how many people on this call have raised capital just saying, hey, invest with me because I think we got a great deal. You got to back it up, right? So using data, using this information, whether it's Yardy or another source, you're going to have a data-driven model for a lot of investors today. So like I said, we've got rents, we've got occupancies, we've got unit mixes and unit counts. We have the past sales information at the property level, as well as the market and submarket level. We've got direct owner contact and direct property contact information. So if you're trying to do deals off market, you can go into our platform, look at a property. Okay, Bill Smith from Smith Enterprises owns the deal. Here's his phone number. Pick up a phone. Hi, Bill. I want to put an offer in on your deal before it goes to market. Are you interested in selling? So tons and tons of information that you can use. I'd be happy to show anyone kind of a demo of the platform at another time. Julie, you have my contact information. I can put it in the chat as well.
Yeah.
And then happy to talk very, very granular. I love talking about markets and sub-markets too. But like I said at the beginning, my 9 to 5 talks at the 30,000 foot level, and my 5 to 9 o'clock the next morning is all about the deals. I love getting involved on the GP side, love getting involved on the LP side. So I like to do both.
Can before you jump, can you tell us a little bit about that, the deal that you're working on? Kind of weave that in. Tell us a little bit about that.
Sure. And I know there are a number of people on the call in Austin. Austin is a fantastic market right now. Two of the metrics that I look at most non-real estate related are in-migration and job growth. And you couldn't find a better market than Austin, Texas for in-migration and job growth. Currently it's 140 units south of Austin in a town called Lockhart, right off of I-35, kind of in the San Marcos area. And we're looking to do an investment and development deal. We're looking to add a phase 2 of another 140 plus units. So the strategy there that we're trying to execute is get in, use the existing property. It's cash flowing. It's a 2019 build, so pretty much brand new. Use that as kind of our foundation and then build on top of that. And we like that model a lot because we're not completely exposed to development. We're not completely sunk into an existing deal, but it gives us a little flexibility on both ends. So our strategy is find markets in the path of growth. We've recently done a deal out west of Fort Worth that we liked a lot in terms of the path of growth where these markets are growing. We've looked at some deals. I've looked at some deals personally in the Denver, Colorado Springs I-25 corridor. I know we've got some Coloradans on the call as well. I see the I-25 corridor and the I-35 corridor in Texas to be very similar ideas, very similar to what the I-95 corridor in the Northeast was 50, 60, 70 years ago. And I don't think it's that much of a stretch to think that from Fort Collins to Colorado Springs, a stretch of about 150, 200 miles will be one giant suburban metroplex. From Dallas to San Antonio, same general distance. I think that will be one large metroplex. And this is a long-term strategy. This is a 10, 15, 20-year strategy. But when I look at my very hazy crystal ball, those are the areas that I think we're going to see continued real estate development, continued job development, and continued in-migration from the coasts for the cost of living, for the quality of life, and just the ease of doing business.
Well, we could go on for hours, and I so appreciate you, Chris, being here. You're just such a wealth of knowledge, and everybody gets so much out of our conversation. So thank you so much. I put Chris's information in the chat box. As we've talked about in the past, these are your partners. These are people that you want to do business with. You want to make sure that the time that you spend with them, you're also offering them some reason to do business with you as well. So don't just take, give a little bit more too on the back end. So